Last year, American motorcycle riders paid over $4 billion in insurance premiums. Most of them have no idea what they actually paid for. In this video, we are going to expose exactly how the insurance industry overcharges riders, which coverages are complete waste of money, and 5 things you can do this week to pay significantly less without sacrificing real protection. This is the video your insurance company prays you never watch. Chapter 1. The racket nobody talks about. Let me ask you 3 questions. Did your insurance premium go up last year, even though you filed 0 claims? Do you actually know what every line item on your policy covers? And more importantly, what it doesn't? And has your insurance agent ever called you proactively to tell you how to pay less? If your answer to all 3 is no, you are not alone. You are one of millions of riders who have been paying into a system specifically designed to take as much of your money as possible while giving back as little as they can justify. Here is the dirty truth about how motorcycle insurance is priced. Your premium is not calculated based on your individual risk as a rider. It is calculated based on statistical pools, massive groups of riders that you are lumped into based on age, zip code, bike type, and a dozen other factors that have nothing to do with how carefully you ride. So when a 23-year-old in your zip code wraps his sport bike around a guardrail, your premium goes up. You have never met this person. You have been riding carefully for 30 years. It does not matter, you are in the same pool. This is the foundation of the racket, and once you understand it, everything else makes sense, including why your premiums keep climbing even as your experience keeps growing. But the pool pricing is just the beginning. The real money is made in what they put in your policy without explaining it, and what they leave out without telling you. Chapter 2. The coverage trap. Open your current motorcycle insurance policy. Find the declarations page, the summary at the front that lists every coverage and what you pay for it. Most riders have never read this page carefully, and the insurance industry is counting on that. Here are the 3 coverages that consistently overcharge riders, and what they actually deliver when you need them. Accessory coverage. This sounds fantastic. Your custom exhaust, your upgraded seat, your saddlebags, your GPS, all covered if the bike is stolen or damaged. Right? Read the fine print. Most standard accessory coverage caps at $1,000 to $1,500. The average rider's accessories are worth 3 to 5 times that amount. So you are paying a premium for coverage that covers 30 cents on every dollar of your actual accessories. The fix: call your agent and ask for the actual limit on your accessory coverage. Then add up what your accessories are genuinely worth. If there is a gap, and there almost certainly is, either increase the limit or stop paying for coverage that is theater. We make videos the motorcycle industry wishes didn't exist. If you want to keep seeing the side of this business nobody else shows you, subscribe, because there is a lot more where this came from. Total loss replacement. This coverage promises that if your bike is totaled, they will replace it with a new equivalent model. It sounds generous. What they do not tell you is how they define equivalent. It is not what you paid. It is not what it costs to replace today. It is the actual cash value, which means they apply depreciation, adjust for market conditions, and hand you a number that is almost always lower than what you need to actually replace your bike. A 5-year-old bike that you paid $12,000 for might be valued at $7,000 by the adjuster, leaving you $5,000 short of replacing what you lost. Roadside assistance. Here is the most quietly overpriced item on most motorcycle policies. Roadside assistance sounds essential, but the coverage most insurers provide is extremely limited, often capped at a tow distance of 15 miles, with exclusions for certain rural areas. If you break down on a rural highway, which is exactly where most of you ride, you may find yourself outside the coverage zone entirely. And here is the kicker. If you are already a member of an organization like AAA, or have roadside assistance through your auto insurance or a credit card, you are paying for this twice. Pure profit for the insurer, pure waste for you. Now you know what is hiding in your policy, but here is what makes this even more frustrating. Older, experienced riders are being charged more for this questionable coverage than they should be, and the reason why will genuinely anger you. Chapter 3. Why riders over 55 pay more and how to fight back. Here is something the insurance industry will never say out loud. They profit from experienced riders who do not question their premiums. Statistically, riders over 55 are involved in fewer high-speed accidents than younger riders. They ride fewer miles per year on average. They own heavier, more stable bikes rather than aggressive sport bikes. By almost every meaningful metric, an experienced rider over 55 is a lower risk than a 25-year-old on a leader bike. And yet premiums for older riders keep climbing. Why? Because insurers apply age-based pricing that penalizes older riders for slower reaction times and increased injury severity in accidents. Factors that are statistically real, but are applied as a blanket penalty regardless of your individual record. Like this video, it is the best way to support this channel. The system is not designed to reward your 30 years of clean riding. It is designed to maximize revenue from the pool you happen to be in. Here is how you fight back. 5 specific moves that most riders never make, but should. 1. Request a loyalty discount review. If you have been with the same insurer for more than 3 years without a claim, call and ask specifically, what loyalty discounts am I currently receiving and what additional discounts am I eligible for? Many insurers have discounts that are never automatically applied. You have to ask. 2. Take an advanced riding course. Most insurers offer a premium reduction for completing an MSF advanced course or equivalent. The course costs around $250. The annual premium reduction is often larger than that, meaning the course pays for itself in year 1 and then keeps saving you money every year after. 3. Adjust your mileage declaration. Most riders dramatically overestimate their annual mileage when taking out a policy. If you rode 4,000 miles last year but declared 10,000, you are paying for a risk profile that does not match your actual riding. Call your insurer, provide your actual odometer reading, and ask for a mileage-based reassessment. 4. Increase your deductible. If you have a strong emergency fund and your bike is not brand new, raising your deductible from $500 to $1,000 can reduce your annual premium by 15 to 25%. You are self-insuring the small stuff and using your policy for what it was actually designed for: catastrophic loss. 5. Shop the market every 2 years. Insurer loyalty is a one-way street. Your insurer will not proactively move you to a cheaper product, but competitor insurers will offer significantly reduced rates to win your business. Set a calendar reminder every 2 years to get 3 competing quotes. The average rider who does this saves over $200 annually just from making a 30-minute phone call. Now, I can already hear what some of you are thinking. Just switch insurers. Problem solved. And honestly, that is not bad advice. But here's the thing. Switching blindly is how riders go from being overcharged by one company to being burned by another. Because the switching process has its own set of traps that the industry has specifically designed to catch you off guard. Here is what you need to know before you cancel anything. Chapter 3. B. The switching trap. What insurers don't tell you when you leave. So you've gotten the competing quotes. You found a policy that's $200 cheaper with seemingly identical coverage. You're ready to switch. This is exactly where the industry has one more trick waiting for you. Claims reputation. Price comparison sites show you premiums. They do not show you how an insurer behaves when you actually file a claim. Before switching, go to NAIC.org, the National Association of Insurance Commissioners. Every licensed insurer in America is required to publish their complaint ratio there. An insurer with a complaint ratio significantly above the industry average is cheaper for a reason. They are difficult when claims are filed, slow to pay, and aggressive about finding reasons to reduce settlements. That $200 annual saving disappears the first time you sit across from one of their adjusters. The coverage gap. This is the most dangerous switching mistake, and it happens constantly. A rider cancels their current policy on Monday, planning to activate the new one the same day. The new insurer has a processing delay. For 6 hours or 6 days, that rider has zero coverage. The rule is simple. Never cancel your existing policy until your new policy is confirmed in writing with a start date before your cancellation date. 1 day of overlap is always better than 1 hour of gap. The introductory rate trap. Many insurers offer aggressively low rates to win your business, rates below their standard pricing. Then at renewal, quietly and without fanfare, the rate adjusts to standard pricing. The $200 saving in year 1 becomes $50 in year 2 and nothing by year 3. When you get a new quote, ask directly, is this your standard rate or an introductory rate? A reputable insurer answers honestly. An evasive answer tells you everything you need to know. Switching can absolutely save you money, but only if you switch smart. You now know how to pay less. But there is one more thing you absolutely must know, and it is the part the industry is most desperate to hide: what actually happens when you file a claim. Chapter 4. The Claim Game. You have paid your premiums faithfully for years. Now something goes wrong. You file a claim, and you are about to discover that the real product you bought is not protection, it is a negotiation. Here is what happens the moment you file. The insurer assigns an adjuster. This person works for the insurance company. Their performance is measured partly on how efficiently they close claims, which in practice means how low they can settle them while keeping you from escalating. The adjuster will assess your bike. They will use their own valuation tools. Not the market rate you would pay to replace the bike tomorrow, but a proprietary system that almost always produces a number lower than retail market value. Here are 3 things you should never say to an adjuster. Never say, "I'm not sure" about any detail of the incident. Uncertainty is used to delay and reduce settlements. Know your facts before you call. Never say, "It was partly my fault," even if you believe it might have been. Fault determination is a formal process. Anything you volunteer is used against you. Never say, "I just want this resolved quickly." This signals to the adjuster that you will accept a low offer to close the claim fast. Take your time. The urgency is theirs, not yours. And here is your single most powerful tool in a claim. Get an independent appraisal. You are entitled to dispute the insurer's valuation. A qualified independent motorcycle appraiser will typically produce a valuation significantly higher than the insurer's initial offer. The cost is usually $100 to $200. On a total loss claim, this investment almost always pays back many times over. Chapter 5. The Smart Rider's Playbook. Here is your action plan. 5 things you can do this week. 1. Pull out your declarations page and find your accessory coverage limit. Compare it to the actual value of your accessories. If there is a gap, fix it or stop paying for it. 2. Call your insurer and ask, what discounts am I currently receiving and what am I eligible for that I am not receiving? Write down everything they say. 3. Check your declared annual mileage against your actual odometer. If there is a significant gap, call and get it corrected. 4. Get 2 competitor quotes today. Use a comparison site or call directly. You may find identical coverage for significantly less within 30 minutes. 5. If you have not taken an advanced riding course in the last 3 years, book one. It saves money, it makes you safer, and it signals to your insurer that you are a lower risk rider than the statistical average for your age group. The motorcycle insurance industry is not your enemy, but it is not your friend either. It is a business built on complexity, inertia, and the reasonable assumption that most riders will never look closely at what they are paying for. You just look closely. Now go make the calls and keep that money where it belongs, in your pocket, not theirs. Click on the next video to continue the ride. Like this video if you save some money. And don't forget to subscribe so you can join our tribe.